Hi, and welcome back to this, the second last in this series of videos. Today we're going to take a look at monitoring a portfolio and rebalancing. In this session in particular, we're going to have a look at each of these two topics. First, we'll have a look at monitoring, followed by a short discussion of rebalancing. In this session, we're going to take a look at the fiduciary responsibility of fund managers, portfolio managers, to monitor and, as required, to restructure a portfolio to ensure that the original investment portfolio statement and strategy is still consistent. In this session, we'll explain how that responsibility works. We'll contrast how the monitoring of investor circumstances for market, economic, and personal conditions of the client are going to affect the portfolio, and interpret the effect on the portfolio changes in each area. We'll go step by step, and we'll evaluate the need to revise an investor's investment policy statement and strategy, and the strategic allocation given changes in things like change in wealth, time horizon, liquidity requirements, tax concerns, and legal and regulatory factors. And we'll take a look at the type of revisions that would be required. The fiduciary responsibility for monitoring essentially comes from that duty of care, the duty of trust that managers have to look after the best interest of their client. Essentially, it means that we have to know our client. We have to continually revise the information that we hold on our client, not just periodically as required by law, but on a consistent basis as things change. This fiduciary duty means that investment actions need to consider the client's needs and their circumstances, the basic characteristics of investments, the basic characteristics of the portfolio. And as things change, that fiduciary liability means that we have to have a systematic process for monitoring those conditions. When we look at some of the things, the changes in investor circumstances, well, for this part, we're principally going to be talking about individuals, but many of these conditions will also be things we have to consider when we're looking at changes for funds and other types of portfolios. This always starts off by continual contact with our client, meeting with clients on a regular basis, and updating the investor's profile, trying to identify any changing circumstances that could require revision, and bringing that portfolio into line with the new set of circumstances. And it'll look at things that we will look at individually next, that include things like wealth, liquidity requirements, time horizon, legal and regulatory factors, and any other unique circumstances. Changes in investor circumstances and wealth include things like change of employment, marital circumstances, change in the number of children. Things like that will definitely affect an individual's investment plans. Anything that would affect income, expenditures, risk exposure, risk preferences, and ultimately retirement income. Any changes in wealth that can arise from savings, spending, investment performance, especially outside of our portfolio, and events like gifts, donations, or inheritance. Large changes in wealth may affect the investor's return requirements, risk tolerance, and the time horizon, so all of these items are going to be interrelated. And any kind of short-term change, a transitory change in wealth, is something that we're not going to use to modify immediately modify the portfolio requirements, but are things we need to be aware of. Liquidity requirements may also be a factor. Liquidity requirements could change because of things like change in employment status, illness, retirement, divorce, buying a home, and so on. Institutions may see liquidity affected by large capital projects, which create short-term claims against that wealth pool, or changes in a benefit plan, changes in demographics for perhaps a beneficiary population of retirees. Major withdrawals can constrain commitments to illiquid investments, like those alternative investments we've talked about earlier, and This may require a higher allocation to liquid investments and limited price risk, certainly some price risk. We also may see changes to the investor time horizon. And naturally, for individuals, time horizons become shorter as we get closer to retirement or closer to our end game. They may shift abruptly because of events like a death of an income-earning spouse or perhaps being the last beneficiary in a family trust. Such changes can require overhauling the asset structure to meet the new needs of the new time horizon. There may be changes in tax circumstances. Now, I'm not a tax lawyer and I don't know all of the conditions that are going to be relevant in each different jurisdiction, but some of the types of changes that we could see include deferring income as much as we possibly can from a high tax year to perhaps a future lower tax year. For example, if you had decided to take a sabbatical year and travel, and you had two streams of income from employment and income from your investments, it might be a good idea to put off any income from those investments from this year into the next year. That way you'll pay a lower average tax rate over the 2 years, and your sabbatical year would be much more comfortable. Perhaps realizing short-term losses. If you have a capital loss because of an investment that didn't perform, it may make sense to sell that before the end of the trading year, and using the capital losses from that unsuccessful investment to offset some of the gains that were realized from perhaps other capital gains. Perhaps we can move expenses into a high tax year. Try to take any possible deductions that you can in the high tax year where you're paying a higher tax rate than the next year, which might be a lower one. Perhaps also deploying assets with large capital gains that you haven't yet claimed in order to step up the cost to market value. For example, donating securities to a family trust or to a charity rather than cash in order to take advantage or to miss out on that capital gains tax. And also reducing or increasing commitment to tax-exempt securities like, as Canadians are very much want to do, RRSPs and retirement education savings plans. In other jurisdictions, like the United States, into employee pension plans. We also, for all of these situations, need to be able to monitor changes to risk attributes. Things like the return average, volatility, correlation between asset classes. All of these things change over time as the economy changes and perhaps the nature of those investments changes. And so that might prompt a reallocation of assets from one class of assets to another. And that can also present an opportunity if the changes are going to be transitory, if they reflect perceived rather than the actual or real underlying differences. Economic changes, of course, will also be important, and we look at all of the type of economic changes we discussed earlier in the course. Anything that will affect the change in short-term risk and reward may require short-term tactical adjustments. Major swings in different types of markets or asset classes may provide temporary, transitory opportunities. We also need to be aware of what's happening in the larger economy, in the fiscal and especially the monetary policy. That's where we get statements like, well, don't fight the Fed. So interest rate changes may be important. Shifts in the yield curve may be things that will adjust or require an adjustment in our portfolio. Monitoring in general then needs to requires an evaluation of events and trends that are going to affect the prospect of individual or fund holdings and asset classes, and suitability for meeting overall client objectives. Any of these things can affect our investment policy, strategy, and statement, and require short-term or perhaps even permanent substitution of different holdings. shifts in asset values may create unintended divergences from the plan. If you were very, very successful in real estate, perhaps you've got to reevaluate your overall portfolio strategy, and that leads us to the next step, rebalancing. Consider an investor who's got a portfolio with only 2 assets. In this case, we have a chart for the last 2 years for our 2 holdings. One was Tesla and the other was Walmart. Both are successful investments. However, Tesla was a lot more successful than the Walmart investment. If at the beginning of the year you had invested $1,000 in each of Tesla and Walmart, you saw that your investment in Walmart rose a little bit over the year, perhaps providing a 10 or 15% rate of return over the entire investment period. However, the investment in Tesla, well, quite volatile and definitely went up an awful lot higher a few months ago than it's at now. Your $1,000 investment would be worth 10 times as much, more than $10,000. So your total portfolio has gone from $2,000 up to about $11,000, a little bit more than $11,000. Now, the problem here is that your original 50-50 allocation, Tesla and Walmart, has now shifted, so you're now more than 90% invested in Tesla and 10% still invested in Walmart. So the Walmart investment hasn't changed, but the percentage of the portfolio has. So what should you do? Now, a normal neutral rebalancing strategy would essentially say, now is the time to sell off about $5,000 of our Tesla investment and shift that into the Walmart investment. Although this seems to be very much counterintuitive, because why would you sell your outperformer and reinvest in that lower performing stock? Well, that's largely what rebalancing is about, rethinking the allocation and deciding whether or not you do want to stick with your same strategy of being 50-50 invested in those 2 stocks. Rebalancing is a trade-off between the cost of rebalancing and the cost of not rebalancing. The benefit of rebalancing, it reduces the present value of losses expected by not sticking to the optimal asset allocation. There is a risk that if we don't stick with the original allocation, we could see a major loss in the next period. Think of it as starting from a zero base. If somebody said to you, should we invest 90% in Tesla today and 10% in Walmart, you'd say that's a bad idea. So you'd say we'll go 50-50. So essentially you're starting off from that zero base and reimagining the entire portfolio. But we see even in normal types of investments, there's a drift of asset mix that causes risk factor drift. Rebalancing restores overall risk exposure. And clearly, with a beta of more than 2 and all of the unusual events that would happen with one stock, like for Tesla, that would be a much riskier portfolio investment than the alternative. There are costs that are going to be involved. Every time we do a transaction, there will be a variety of transaction costs that we discussed earlier when we talked about execution cost. And there may also be tax liability from realizing a gain. If we sell off the Tesla stock, then we're going to have a capital gain, which will be taxed not quite as income in most jurisdictions, but it will be taxed, unless you're a tax-exempt organization. There are a variety of approaches to rebalancing. A couple of the major ones that we'll look at here include things like calendar rebalancing, basically rebalancing the portfolio on a periodic basis, looking at it on a month-to-month or week-to-week basis and deciding whether we've shifted the balance from the original allocation. It doesn't require continuous monitoring. It does require monitoring on that periodic basis, but not on a minute-to-minute basis. And it's largely insensitive to changes in the market. It doesn't really need to be aware of trends. An alternative approach is percentage of portfolio rebalancing, one that's a little bit more complicated, one we'll talk about in a bit more detail. We rebalance after a certain threshold has been crossed. Essentially what we do is we set up a lane or a corridor, and whenever the value of the asset class strays out of that corridor, then it's time to look at rebalancing. Market performance will be important. If we have strong trending markets, there'll be requirement for much more control, and it'll require much more frequent and perhaps constant monitoring. Setting those targets for corridors for asset classes is going to depend on a number of factors, and here we have 5 of them. Transaction costs. Higher transaction costs imply wider corridors. In other words, we want to reduce the amount of trading because we want to reduce the transaction cost. Higher risk tolerance also allows us to shift our corridors wider. Correlation with the rest of the portfolio. Higher correlation means future moves are unlikely to cause further divergence, and so we can also relax a little bit on the corridor width. Asset class volatility. More volatility means we're going to have more costly moves, which calls for a tighter corridor. And volatility relative to the rest of the portfolio could also lead to large divergences, calling for tighter corridors. We may also set target weights instead of having allocated or allowed range. And rather than rebalancing to the weight, in this case, we'd rebalance within the target corridor. So perhaps every time we move using a rule-driven approach halfway to our target weight, that would be the time to consider selling or buying more of that asset class. And there's also an experience or judgment-based approach, which make tactical adjustments on the basis of short-term judgment. This approach allows better control over things like illiquid asset, alternative investments, and so on. And it's more closely aligned with strategic allocation, but provides lower transaction cost. Now, different types that we're certainly aware of, and we're going to talk about in the final part of this session for rebalancing. We have 3 major types. The first that we'll look at is called a buy and hold rebalancing strategy. Essentially, in this case, we follow the Warren Buffett and Charlie Munger approach. We buy our initial target mix and do nothing afterwards. We may perhaps invest only part of the portfolio in the actual asset class, and our one decision will be not to buy more of a particular stock, but to buy more of the mix of stocks and balance that against a base of cash for short-term securities. So those risk-free securities provide a minimum rate of return to the investment. Let's say we're going to go 90% into equities and 10% into cash. The minimum return we'll get will be 10% times the risk-free rate of return. So the total portfolio value then becomes the amount that we're going to earn from the portfolio of equities plus the floor value that's provided from risk-free investment. The floor value represents the downside limit. In other words, the shortfall requirement may be covered by that. And the returns are going to be linked to stock performance with no upside, and the expected return being the long-term rate of return to that asset class. Allocation directed to stock performance could fall to 0 as 0% stocks, or rise to 80-90% stocks as the market is trending perhaps. Implies risk tolerance that's positively related to wealth. In other words, the richer you are, the more willing you are to take risk, and stock market returns. It does well in trending markets that are increasing or decreasing, as better performing assets gain increasingly larger weights. Now, we hear often that buy and hold is something that's been and gone. However, we still hear that Warren Buffett is increasingly successful. So I do constantly see headlines like this in the Globe and Mail or in CBS Market Watch. From the Wall Street Journal, it says buy and hold is still dead. In fact, people have even written a book or written several books saying that, more tongue-in-cheek, that buy and hold is dead. Again. So what are some of the alternatives? We could have constant mix and constant proportion rebalancing strategies. In a constant mix strategy, This is a dynamic strategy of rebalancing to the initial allocation, reacting to market conditions with regular trades. Maintains stable portfolio risk characteristics because we keep the risk in the portfolio relatively constant. Provides, well, at least it is expected to provide, superior returns versus buy and hold if we see more reversals than trends. It's contrarian with liquidity providing strategy, and it's consistent with risk tolerance that varies proportionally with wealth, as with the buy and hold. Constant proportion rebalancing strategy is a dynamic strategy which targets where target allocation is a function of a cushion, and allocation of stocks is going to be based on essentially a floor value times the cushion. It's consistent with zero risk tolerance. In other words, zero risk tolerance, we have zero cushion. Buy and hold is a special case where that risk tolerance is equal to 1. And for risk tolerance greater than 1, we have something called constant proportion portfolio insurance. And that requires selling stocks as share prices decline and buying them as they rise. And a floor is established dynamically with higher allocation to stocks as higher allocation to stocks lowers floor and lower allocation to stocks raises it. Performs poorly in markets characterized by reversals due to high transaction costs. If we've got a dynamic and constantly changing market, transaction benefits, the benefits of investments are going to be wiped out by the higher transaction cost. You can see that the shape of our portfolio will vary according to our strategy. A buy and hold strategy is essentially linear, with portfolio returns are a linear function of stock returns. And I'll show you an image of that in a second. In a constant mix approach, we'd say that the portfolio returns are going to be concave. Our portfolio returns increase at a decreasing rate with positive stock returns, and decreases at an increasing rate with negative stock returns. And in the constant proportion case, it's convex. Portfolio return increases at an increasing rate with positive stock returns, and decreases at a decreasing rate with negative stock returns. And if we see this on a chart on the vertical axis with the rate of return to our stock and the rate of return to our portfolio, in a buy and hold approach, the returns are going to be proportionate. As the value of our stocks rise, the value of our portfolio rises proportionately. With the constant mix, we may do better in the middle part of the range where the stock rises at a moderate rate, but where we have high levels of reversals, we have a decreasing performance relative to the buy and hold. And in constant proportion, we see that we have that convex approach with the best returns in trending markets. Right. Well, that gives us an introduction to both monitoring and to rebalancing. And most importantly, we remember that monitoring is a fiduciary requirement, that rebalancing, whichever strategy that we're going to approach, requires either a periodic or an approach that's going to take a look at our boundaries or our alleys or corridors. I hope this has been useful. We have one more video left in this series, and I look forward to seeing you then. Thanks.